Hi there, I'm Loong Lim. I'm a portfolio manager on the Ashoka WhiteOak Emerging Market Trust. It's been an interesting 3 years since the trust was launched, with many significant events occurring. I think probably the biggest highlight is that the trust has delivered for clients what we designed it to do. So if we take a step back and think about how the portfolio is constructed and some of the key characteristics of the trust, portfolio construction of the trust is designed to deliver outperformance through stock selection, whilst mitigating factor risks, including things like geopolitics, macro, oil price moves, etc. So done correctly, this should avoid big swings in alpha relative to the benchmark, as we avoid taking those big macro bets. So if we look back at the last 3 years since the trust was launched, it's been a fairly turbulent period, big moves in FX, in the oil price, a lot of geopolitical issues such as tariffs going on, but the trust has managed to deliver an annualized alpha of about 2.5% without any big swings in either direction. Now, a key test of our portfolio construction came in April 2025, when the US announced a whole raft of tariffs on across much of the world. In the immediate aftermath of the announcements and the subsequent market moves, we looked at the performance of the trust relative to the benchmark to see how well we had mitigated that factor risk. And actually, the performance was relatively flat, which to us suggested the portfolio construction was being done correctly. And I'd say the last highlight or the last thing to draw that I like to kind of draw attention to that's been pretty popular with our clients over the last 3 years has been the fee structure, one where we have no management fee and we only charge a performance fee on alpha. So I think that's something that clients appreciate because it provides significant alignment between us and our clients. In terms of challenges over the last 3 years, it would be easy to cite the kind of continuously and quickly evolving geopolitical landscape, but I wouldn't necessarily describe it as a challenge because in emerging market investing, to some degree, that's business as usual. And we do try to mitigate these risks as far as possible, as I mentioned earlier. So realistically for the trust, probably the biggest challenge we've had has been getting enough publicity and scaling it, so getting the message out there. We understand that in recent years, certain clients have been a bit wary of investment trusts because there are discounts associated with some of the trusts in the market. But it's also worth remembering that we have an annual redemption facility that mitigates this risk to a large extent. So really what we're focused on at the moment, beyond kind of generating alpha for our clients, is helping potential clients understand both what we do, but also the characteristics of the trust that have been designed to ease a lot of these concerns. So India has been a very strong area of alpha generation for our team, and that's, I think, something you should expect to continue given WhiteOak as a firm. We have a very strong presence in India on the ground and a very long history there with our first strategy being founded there. But it's worth remembering that the way we designed the portfolio, it's very much for alpha generation to be driven by stock picking rather than country, sector, or thematic bets. So largely, I would expect outside of India, alpha generation to come from, and it has come from, multiple sources across many countries and sectors. So again, it's stock picking that should drive the generation of alpha. And so therefore, going forward, I think you should expect alpha to be well distributed without it being driven by any theme, any sector or any country. Historically, emerging markets have always been thought of perhaps as being slightly more fragile than developed markets, be it at a country level or a company level. And I think, broadly, there's been a little bit of surprise at the performance of emerging markets despite what has been a fairly turbulent geopolitical landscape. I think what a lot of the market hasn't realized is how far a lot of these emerging market countries and companies have come. So the largest emerging market economies today are far less indebted than they used to be historically, but also than many of their developed market peers. And they actually have, in many cases, better economic growth prospects and lower forecasted inflation. If you think about it on a company level, historically, many emerging market companies were sensitive to the US dollar strength because they used to have US dollar denominated debt whilst servicing that debt with local cash flows. But today, when you look at the financial systems in many emerging markets, they're actually far more developed than they used to be. So a lot of these companies are now borrowing in local currency. So you remove that layer of FX exposure. And further, the kind of integration of emerging market companies into global supply chains means many of them are actually charging for their products in US dollars rather than local currency. So again, mitigating a lot of that traditional risk that's been associated with it. One other point about emerging markets is how they continue to evolve away from historical perceptions. If you think about, someone telling you in the past that a company from China or somewhere else in emerging markets was competing with a developed market company, you would think of it very much in terms of low cost manufacturing, lower costs, but also lower quality. I think nowadays it's very clear in sectors such as semiconductors, renewables, or electric vehicles that companies from emerging markets are by far the market leaders and also the technology leaders, right? But we're also seeing this in more traditional parts of the market. So areas like industrials, you're seeing Chinese and other emerging market companies starting to compete on technology rather than on price alone. So I would say that the historical perception of emerging markets at a country and a company level maybe hasn't kept up with the pace of change that we've seen on the ground. One area we've been receiving a lot of queries from clients is about the AI investment theme, and in particular, how AI exposure in emerging markets differs to that in developed markets. So first thing to point out and to remember is that this trust is not an AI trust, not a tech trust. We maintain a relatively similar exposure as the benchmark to the AI theme, but what we own within that theme does differ. So to go back to the kind of the initial point of how the exposure differs between developed markets and emerging markets, if you think about the AI exposure in developed markets, a lot of the largest names would be the hyperscalers, companies like Google, Meta, Amazon, or even Oracle today, soon to be joined by companies like OpenAI and Anthropic. These are the companies today that are spending huge amounts of capex to fuel the AI boom, right? So they're the ones every year announcing a few $100 billion in capex. That kind of money they're spending is likely to continue and likely to grow in the coming years as they all look to develop an edge in their frontier models. Now, the AI exposure in emerging markets is very, very different. If you think about the biggest companies, TSMC, SK Hynix, Samsung Electronics, I would describe them as AI enablers. They're the ones providing the semiconductors, or in other company cases, the hardware needed for the AI revolution. If you want to use a gold rush analogy, these are very much the picks and shovels that are enabling the AI revolution. So whilst in the developed market space, you have to think about how much capex these hyperscalers are going to spend, how much longer they're going to spend that capex on, and what return they're going to get. The benefit from all this capex investment is falling to the companies in Asia, because they're very much more hardware driven in nature, be it memory, MLCCs, or power. So I think it's very important to note where the differences in kind of Asian AI exposure or emerging market AI exposure versus developed market AI exposure is. So beyond mega caps in Asia, such as TSMC, SK Hynix, and Samsung, we're finding a lot of opportunities further down the market cap or further up the value chain in Asia. So as mentioned earlier, within the portfolio construction process that we have here at the Trust, we don't take bets on particular themes. But when we look at the AI exposure within the benchmark and the AI exposure in the Trust, what you'll notice is that what we do own within the Trust and within that AI exposure are areas that we think will outperform the wider AI theme. So how we find these kind of areas is we first understand the roadmap of how the technology is evolving and what the implications for the hardware are. So essentially, we're looking for the bottlenecks, or we're looking for areas that will benefit disproportionately as the technology evolves, and it is clearly evolving very, very quickly. So for example, if you were to look at power supply, we all hear about how much power AI requires, and with every new generation of AI, that's only increasing. Now, one of the companies involved in the space is a company called Delta Electronics. They are by far the market leader when it comes to AI server power supply. Now, Delta, like many other companies in the supply chain, will benefit from that increased capex that we talked about earlier. But beyond that, they also benefit from an increased wallet share, because if every generation of new AI chip requires more power, naturally the spend on power is increasing. Similarly, another area where you're seeing more more benefit disproportionately is in testing. So you can imagine that a GPU is a very expensive semiconductor. And so you want to make sure before you send it off to clients that it's working as designed. So you're seeing a lot more spend on testing, and in particular system level testing. So there are companies that we own, such as Winway, who make the test sockets, and Hon Precision, who make the test handlers. Again, benefiting disproportionately, not just from the increase in AI spending, but the increased penetration of testing and also the increased complexity. Looking forward to where we're seeing opportunities, the great thing about investing in a universe as diverse as emerging markets is the answer is genuinely everywhere. There will always be niche areas where a well-resourced team such as ours can spend time and find ideas, even in markets where maybe the broader news flow or sentiment might not be the strongest. So there will always be niches in big markets like China, like in India, Taiwan, South Korea, but also in the smaller markets like across Southeast Asia or Eastern Europe. So I would really expect the new ideas in the trust to come from everywhere, across different markets, across different sectors, and not be confined to particular thematics or countries. Thank you so much for spending the time to watch this video. We'd be very happy to answer any further questions. So if you do have any, please visit our website. Thank you.